July 31st, a 67-year-old employee packs a cardboard box, turns in a badge, and walks out after one last payroll deposit into a health savings account. For years, the plan seemed simple. Keep working, stay on the company health plan, delay Medicare, keep contributing to the HSA. Then retirement starts. The Medicare application goes in, and the expected start date feels obvious. Now, August 1st. New chapter, new coverage. But the letter says something else. Medicare Part A does not begin in August. It reaches back 6 months, back into February, back across paychecks that already happened, back across HSA contributions that looked completely legal when they hit the account. Nothing changed in the employee's behavior. The calendar changed after the fact. How can that happen? The trap begins with a belief that sounds perfectly reasonable. If you delay Medicare, you can keep funding your HSA. That belief is close enough to feel safe, and that is what makes it dangerous. I am going to walk you through the timing rule behind this, not to argue that health savings accounts are bad or that delaying Medicare is always a mistake. It is narrower than that. This is about what happens when Medicare dates and tax contribution rules collide. By the end, you will know the practical takeaways. When HSA contributions may need to stop, why Social Security can cause Medicare Part A to begin automatically, and what to do if an overcontribution has already happened. This is education, not personal tax or legal advice. Your employer, Medicare, your HSA administrator, and a qualified tax professional are the places to verify your exact situation. The assumption to overturn is simple. Medicare does not always start when you feel like you asked it to start. Sometimes the system assigns a date, and the tax rules judge your HSA contributions against that date. To see why the rule feels so unfair, we first have to separate two things people often treat as one: having an HSA and being allowed to contribute to it. An HSA has two lives. One life is the account itself, the money already inside it, the debit card in your wallet, the investment balance on the website. The other life is contribution eligibility. That is the permission to put new money in. Medicare affects the second one. If you already have an HSA and then enroll in Medicare, the old money does not disappear. The account does not close because you turned 65. You can still use that balance for qualified medical expenses, including many costs you may face in retirement. Doctor bills, prescriptions, dental work, vision care. That part is not the trap. The trap is funding it. To make a valid HSA contribution for a month, you generally have to be HSA eligible for that month. That means you are covered by a qualifying high-deductible health plan, and you do not have other disqualifying coverage. Medicare is disqualifying coverage. So once Medicare covers a month, that month is no longer a month where you can contribute to an HSA. And this is where people get caught, especially if they are still working. They think, I am on my employer plan. I have not retired. Payroll is still taking out HSA money. My company is still making deposits. So everything must be fine. But the tax rule does not only look at whether you are employed, it looks at whether you are eligible. And employer deposits count too. If your company puts money into your HSA after you are no longer eligible, that is part of the same problem. It is not magically different because it came from human resources instead of your paycheck. So the clean split is this: spending old HSA money can continue after Medicare. Adding new HSA money generally cannot. That distinction matters because the account may look normal while the tax problem is quietly forming underneath it. The website still works. The payroll deduction still shows up. The employer contribution still lands. But the real problem is not the month you enroll in Medicare. It is the months Medicare later says you were already enrolled. Here's the rule that makes this feel backwards. If you enroll in Medicare after age 65, Medicare Part A can start before the day you actually sign up. Not always by a few days, by up to 6 months. But it cannot go back before the month you turn 65. So if you enroll at 65 and 3 months, the lookback can only reach back 3 months. If you enroll at 68, it can reach back the full 6. On paper, this was meant to help people. The idea was simple. Someone keeps working past 65, stays on an employer plan, and later moves on to Medicare. The government did not want that person to accidentally accidentally have a gap in hospital coverage just because the paperwork date and the real life transition date did not line up perfectly. So Medicare Part A was allowed to reach backward, a cushion, a safety net. But HSAs turned that safety net into a trap. Imagine you are 67, you are still working, you have a qualifying high deductible health plan. Every payday, money goes into your HSA. Your employer adds a contribution too. Nothing looks wrong. Then in July, you apply for Medicare. Your Medicare card arrives, and Part A does not begin in July. It begins in January. That means January, February, March, April, May, and June are now Medicare-covered months. And once those months are Medicare-covered months, they are not HSA-eligible months. So the contributions made during those months may have been perfectly reasonable when they happened. Payroll processed them, the account accepted them, the employer plan treated you like an active employee. Then Medicare updates the calendar. Same months, different label. That is the counterintuitive part. You did not secretly break the rule in January. You did not know in March that Medicare would later claim March. The problem is created after the fact, when your enrollment is processed and Part A is backdated. This is why retirement planning can fail even when people are careful. One system says you are covered by the employer plan. Another system says you were also covered by Medicare. For HSA contributions, that second sentence is the one that matters. Now the obvious question is, if Medicare is going to look back 6 months, what date does it look back from? The date that matters is not the day you click submit on the Medicare application. It is not the day you clean out your desk. And it is not the day the Medicare card shows up in the mail. The date that matters is the Medicare effective date. That is the month Medicare says your Part A coverage began. And for someone enrolling after 65, that effective date may be up to 6 months earlier than the month they enrolled. This is where the planning rule comes from. If you are over 65, still working, and still contributing to an HSA, the safest general approach is to stop HSA contributions 6 months before Medicare coverage will begin. Or, more practically, 6 months before the Medicare transition you expect could trigger retroactive Part A. That sounds simple until you try to put it on a calendar. A lot of people ask, do I count back from the day I apply? Maybe. But what if you apply in May and request Medicare to start in July? Then the relevant question is not just when you applied, it is what effective date Medicare actually assigns. Others count back from their retirement date. That can also be wrong. If your last day of work is August 31st, but Medicare Part A is made effective March 1st, then the HSA problem did not start at the retirement party. It started back in March. Good planning builds a buffer. It says, before I start the Medicare process, before payroll keeps running, before my employer adds another deposit, I want 6 clean months with no HSA contributions. Bad planning waits for visible proof. It says, I am still working, I still have my employer plan, and my Medicare card has not arrived yet, so contributions must still be fine. That is the trap. Payroll works in real time. Medicare can define coverage backward. Those two systems are not looking at the same calendar until after the fact. So before relying on any countdown, confirm the Medicare effective date you are likely to receive. Check with Medicare, your benefits office, or a qualified advisor, because individual timing can vary. The goal is not to guess the paperwork date. The goal is to avoid contributing into months Medicare may later claim. And there is one move that can spring the trap even if you are still working and never meant to start Medicare yet. That move is claiming Social Security, not Medicare, not a hospital visit, not a decision to switch health plans, just Social Security retirement benefits. For many people, after age 65, filing for Social Security can also trigger automatic enrollment in Medicare Part A. That is because Social Security and Medicare are connected through the same federal machinery. So a worker may think, I am only starting my monthly retirement check, but the system may hear something else. It may hear, start Medicare Part A too. Picture someone who is 66 and still working. They have a high deductible health plan through their employer. Their paycheck still shows HSA deductions every 2 weeks. Their employer still adds money each quarter. Nothing about their job has changed. Then they decide to claim Social Security while they keep working. The first payment arrives, payroll keeps running, the HSA keeps getting funded. Months later, while preparing for retirement, they review their Medicare record and discover Part A did not start when they expected. It started earlier, tied to the Social Security claim. That changes the HSA story, because once Medicare Part A is active, you are no longer eligible to contribute to an HSA for those covered months. It does not matter that you still had employer coverage. It does not matter that you did not use Medicare. It does not matter that nobody at payroll stopped the deduction. The contribution eligibility ended when Medicare coverage began. This is the part that feels unfair. The person did not make a reckless health insurance decision. They did not secretly double dip on purpose. They crossed an invisible line between two federal systems. One system was sending retirement income, the other was starting health coverage, and the HSA rules cared about the second one. That is why Social Security timing belongs in the HSA conversation. If you are past 65 and still contributing, claiming benefits is not just an income decision. It can be the switch that turns on Medicare Part A. Once the line is crossed, the next problem is not just stopping future contributions. It is cleaning up the ones already made. Cleaning it up starts with one blunt fact. Any HSA contribution tied to a Medicare-covered month is treated as an excess contribution. That can include your payroll deductions. It can include employer deposits. It can include a lump sum you made yourself because you thought you were still eligible. And if that excess sits in the HSA, the tax code can charge a 6% excise tax for each year it remains uncorrected. Not once, each year. So the mistake is not frozen in the year it happened. It can keep following the account until the excess is removed or properly absorbed under the rules. The usual fix is not mysterious, but it is time sensitive. In many cases, you contact the HSA administrator and request the return of excess contribution. The administrator removes the excess amount, and if the money earned anything while it was in the account, those earnings may have to come out too. That timing matters. If you catch the problem before filing your tax return for that year, the paperwork is usually cleaner. The HSA custodian can process the correction. Payroll may still be able to adjust records. Your tax forms may line up with what actually happened. But if the discovery comes later, the mess can spread. You may be looking at an amended tax return. If the contribution came through payroll, your employer may need to correct wage reporting. And if employer contributions were involved, it may take more than one office to unwind the same mistake. Then there is the investment wrinkle. A lot of HSA money does not just sit in cash. It may be invested in mutual funds, index funds, or target date funds. So if the excess contribution bought shares and those shares went up or down, the correction is no longer just take out the original deposit. Someone has to calculate the net earnings or the loss connected to the excess. That is why the cleanest solution is speed. Stop the ineligible contributions. Identify the Medicare covered months. Ask the HSA administrator how they handle excess removal before the tax return is filed. Because the trap is not only making the contribution, it is letting the contribution age. But if the rule creates this much confusion, why does it exist in the first place? And who is the real villain here? The real villain is not Medicare. Medicare is trying to do something protective. If you enroll after 65, it can make Part A coverage retroactive for up to 6 months, so you are not left with a gap in hospital insurance. That makes sense. The HSA rule also makes sense. To contribute for a month, you must be HSA eligible for that month. If Medicare covered you during that month, you were not eligible. The collision happens because Medicare can rewrite the calendar after the fact. You made the contribution in March. Payroll accepted it. Your employer may have added money. The HSA custodian processed it. Then, months later, Medicare says March was covered. Now the tax system sees that same March differently. That is why administrators and benefits experts warn this can burden everyone at once. Employees, employers, HSA custodians, payroll teams, sometimes even corrected W-2 forms. No one has to be careless for the mess to happen. Each system is logical alone. Together, they turn 1 month into 2 different answers. So the answer to the opening question is not to panic. It is to plan around the one date Medicare may move backward. The safety check is simple. If you are past 65 and planning to enroll in Medicare, do not only ask when your coverage starts, ask whether Part A will reach backward. That is the open loop. A contribution can be legal when payroll makes it, then become excess later because Medicare retroactively turns that earlier month into a Medicare covered month. So before you pick a retirement date, check 4 things in one sitting: your HSA payroll deductions, any employer HSA deposits, your expected Medicare effective date, and whether Social Security will trigger Medicare enrollment automatically. Then build in the buffer. Stop employee and employer HSA contributions early enough. And if you discover excess contributions, correct them promptly with your tax professional and HSA custodian. This is the core lesson. Retirement planning does not always fail because people ignore the rules. Sometimes 2 systems define the same month differently. If this helped, comment below. Are you working past 65, delaying Medicare, or trying to coordinate an HSA with retirement timing? Thanks for watching.